Okay, then let's now continue with understanding the methods of depreciation. The first method that we are going to look at is called as straight line method. For this we have taken an example. We have an asset which costs us about 4,50,000 rupees. We have estimated that its life is about 5 years, and we believe that at the end of 5 years we can sell it at around 50,000 rupees. So what is the depreciable value? The depreciable value is 4,50,000 minus 50, which is 4 lakhs. And when we use the straight line method, basically it means that we expense this depreciable value equally over the 5-year period. So what we have done, we have subtracted the salvage value or the residual value divided by the useful life, the period of useful life, and arrived at that 80,000 rupees is the depreciation that we will charge each year over the useful life of the asset. So what are the depreciable value here is 4 lakhs. It remains the same across all the years, and each year 80,000 rupees, as we have calculated, is here is charged to the depreciation. The accumulated depreciation is nothing but we are accumulating and saying at the end of year 1 80,000 rupees was the depreciation, at the end of year 2 80 plus 80 we have 1,60,000 as depreciation, etc. So based on this we arrive at reducing the accumulated depreciation from the purchase price, which is 4,50,000. We arrive at what is known as the net book value. So purchase price less accumulated depreciation is net book value. So like that we go on calculating as to what the accumulated depreciation is, and we arrive at the net book value, which at the end of 5 years is 50,000, which is the same as your salvage value or residual value that you had estimated. So this is what a fairly straightforward method of depreciation, and normally is used where the productivity or the wear and tear of the asset does not happen very fast, but is spread equally over time. For example, furnitures and fixtures that you have in your office, usually you use the straight line method. The other method that we are going to talk about is called as the reducing balance or the written down value method. The example remains the same, but unlike straight line value where we estimated the useful life to be 5 years and therefore depreciated it equally across, we will have to use a depreciation rate, which is a estimate that the management has to make. Now that would be beyond the scope of this discussion as to how this 35% is arrived at. That depends upon the business, the machinery, and the management's idea about how they are going to use it. But assuming that that is the rate, here we need a rate of depreciation. Then in this system of depreciation, we start off with the starting book value, which is the purchase price. We charge depreciation at 35%, which is 1,50,500, and that then gets accumulated, and we arrive at the net book value by depreciating by reducing from the starting net book value the accumulated depreciation to arrive at the ending net book value. Then next year, this ending net book value of first year becomes the starting value for the second year, from where again you depreciate at 35%, you add the two, you arrive at the accumulated depreciation, and then you have net book value again of at the end of second year, which becomes your starting net book value, and so on and so forth. Like that you arrive at the final value of at the end of 5 years. So at the end of 5 years, your net book value of the asset after reducing the accumulated depreciation from the purchase price is around 52,000. Normally most businesses do not depreciate even if they continue to use the business after the useful life has been taken off and attained, and the asset is carried at its purchase price. Only when actual disposal takes place does all the other action of adjusting this value comes in, which we will see when we discuss about the disposal of assets. So these are the two methods that we normally practiced, and in India much of the depreciation method followed is the written down value or the reducing balance method. A point to note while looking at depreciation is that any method that you choose, you need to apply it across the years consistently. Changing depreciation method is not considered very healthy practice. Further, different categories of assets, for example, your plant and machinery, you may have a different rate. Your furnitures and fixtures will have a different rate, your vehicles have a different rate, and so on. A building will obviously have a different rate. So you can have different categories of assets which can be depreciated at different rates. Also, the method that you use for different categories can be different. For example, furniture can be using straight line method, and photocopiers, for example, can be using the written down value or the reducing balance method. Also, when you acquire an asset, normally this is for a whole, the accounting period is normally considered as 1 year, and therefore when depreciation is charged, it is for the whole of the year. But it can happen that you have acquired assets in the middle of the year or somewhere down. Say example, if you have accounting year which is 1st April to 31st March, you have acquired something in June, then proportionately it will be ideal that you charge so 9 months, in case you have acquired the asset in June, then from July to March, 9 months should be charged. In India, the practice is that if you have purchased the asset in the first half of the financial year or the accounting period, then you charge the full depreciation. But if you have acquired it in the second half of the financial year or accounting period, you then charge half the depreciation. But ideally, proportional depreciation should be charged. Also, it should be noted that in most countries the tax authorities provide a totally different depreciation rate than what a company or a firm or a business would use internally for its own purpose, estimating the useful life, etc. Now, this is because there has to be consistency across when calculating tax rates and the tax income for the government, and they cannot leave it to whims and fancies of the business to decide as to what the depreciation rate should be. So, the tax depreciation rates and the tax accounting that is done is a separate topic which is out of the scope of this discussion. So, what are the accounting entries that we pass once depreciation has been calculated? The obvious thing, we have already said that depreciation is a charge to income in that particular year. We are spreading the cost of a capital expense over, or a capital expenditure over, a certain number of years, and depreciation is a charge to the income, which is, it has to be debited to the P&L account or the profit and loss account. So, basically we debit P&L account, which is depreciation expense, and you will, what have we said? We have said that the value of the asset is to be reduced over a period of time. Now, logically you would want to say that the credit therefore should go to the asset account. The practice is not to do that. The practice is to credit what is called a accumulated depreciation account, and the entry that comes in is that you debit P&L depreciation expense and credit accumulated depreciation. Now, this always will have a carry forward balance, which will be a credit balance. So, what we need to again understand is the accumulated depreciation can be for each category. When you maintain accounts, you can say that for every rate, plant and machinery, buildings, furnitures and fixtures, you can have separate accumulated depreciation accounts, and the while presenting the balance sheet, you can reduce from the asset value, the purchase value, the accumulated depreciation to show as to what the book value or net book value is.